In 2010, a programmer paid 10,000 Bitcoin for 2 pizzas. Those pizzas are now worth $650 million. Gold investors laugh at that story until you ask them what gold returned in the same window. Then it gets quiet. Here's what nobody in this debate wants to say out loud. Both sides are partially right, both sides are partially wrong, and the way you answer this question will determine whether the next 20 years make you wealthy or just comfortable. And those are two very different things. Everyone thinks they understand gold. They don't. Gold is not an investment. It never was. It's a 5,000-year-old insurance policy. And insurance doesn't make you rich, it stops you from going broke when everything else burns. Here's the number that changes how you see this entire debate. From 1980 to 2000, 20 full years, gold lost 70% of its real inflation-adjusted value, while the S&P 500 returned 1,700% in the same period. 70%. 2 decades. Quietly bleeding while stocks exploded. Nobody talks about that window. Gold bulls skip straight to 2008, to COVID, to every crisis where gold shined. And yes, it shined. Every time paper currency collapsed somewhere in the world, gold crossed borders, held value, got families out. But that's the point. Gold wins when systems fail. When systems are functioning, gold just sits there. And here's the uncomfortable follow-up question. How often do systems actually fail? Because if you're betting on collapse, gold is your asset. If you're betting on transformation in a world that looks fundamentally different but still functions, gold might be the most expensive comfort blanket in financial history. But before you write gold off completely, there's one thing Bitcoin did in 2022 that every crypto bull quietly wants you to forget. 2022 was supposed to be Bitcoin's moment. Inflation at 40-year highs, the Fed hiking aggressively, markets collapsing. Every condition that Bitcoin was designed for, a broken monetary system, a crisis of institutional trust, a dollar losing purchasing power in real time. Bitcoin dropped 65%. Gold dropped 2%. The entire digital gold narrative, the one that had been repeated confidently for years, got stress tested in public and failed visibly. What actually happened was simple and brutal. When institutions needed liquidity fast, they sold their riskiest positions first. Bitcoin was at the top of that list, not because it was broken, because it was the newest, the least understood, and the easiest to dump without shareholder questions. That event didn't kill Bitcoin's long-term case, but it revealed something important. Bitcoin at this stage is not a defensive asset. It's a high-conviction asymmetric bet. Those are completely different things. And confusing them is exactly how people lose serious money. Gold does one job. Bitcoin does a different job. The question is which job you actually need. Let's do the real math. No hedging. Last decade, gold up roughly 70%, consistent, predictable, quietly respectable. Bitcoin in the same window, up over 15,000%. That gap is not an argument for Bitcoin. It's a question that demands an honest answer. Because Bitcoin didn't go up in a straight line. It crashed 80% in 2018. Crashed 65% in 2022. Every single time, mainstream headlines declared it dead. Every single time, it recovered and set new all-time highs. Now here's the micro payoff that most people process wrong. That pattern is either the most compelling case for long-term conviction investing you've ever seen, or the most dangerous narrative trap in modern finance, where survivors tell the story and the people who got wiped out in cycle 3 are too embarrassed to post about it. Both interpretations are valid. The data doesn't cleanly separate them. What it does tell you, Bitcoin rewards people with long time horizons and punishes people who need the money back within 2 years. If your investment horizon is 5 years minimum, and you can genuinely stomach watching 60% disappear without selling, the historical returns are real. If you can't, they aren't real for you, because you won't hold through the crash that always comes before the recovery. And then January 2024 happened, and something changed that made even the most skeptical institutional analysts stop and recalculate. BlackRock manages $10 trillion in assets. They don't make speculative bets. They don't chase narratives. They move slowly, deliberately, and when they move, other institutions follow. In January 2024, the SEC approved spot Bitcoin ETFs. BlackRock launched theirs immediately. It became the fastest growing ETF in the history of financial markets, crossed $10 billion in assets faster than any fund ever launched. Not crypto fund, any fund, ever. Fidelity followed. Franklin Templeton followed. Firms that had publicly called Bitcoin a fraud 5 years earlier were now offering it to retail clients through regulated, SEC-approved products, sitting right next to gold ETFs on every major brokerage screen. Here's why that matters beyond the headline. Institutional adoption doesn't just bring money, it brings infrastructure, custody solutions, regulatory clarity, derivatives markets, insurance products. Every layer that makes an asset feel safe to allocate to, Bitcoin is acquiring all of it, fast. Gold spent decades building that infrastructure. Bitcoin is doing it in years, and once that infrastructure is fully in place, once Bitcoin is as boring and accessible as a gold ETF and a retirement account, the volatility that scares people away today compresses permanently. We may already be in that transition, the window where Bitcoin is still volatile enough to scare off conservative capital, but legitimate enough to hold, is closing. That window is historically where the biggest returns live. Here's the stat that should genuinely change how you think about the next 20 years. $84 trillion is transferring from baby boomers to millennials and Gen Z, the single largest wealth transfer in human history, happening right now, over the next 2 decades. Baby boomers trust gold. They watched it protect their parents. It's emotionally real to them. They can hold it, they can see it, they understand it viscerally. Millennials watched banks get bailed out in 2008 while they graduated into a recession, watched their wages stagnate while asset prices doubled, watched savings accounts return 0.01% while inflation quietly ate their future. They were told the system was fair, then watched it up close and saw who it was actually built for. They don't have the same relationship with gold, but a significant portion of them have a deep, almost ideological trust in math that no government can touch. A Schwab study of self-directed retirement accounts found Bitcoin was the most requested asset among investors under 40. Gold didn't crack the top 5. Now think about what happens when $84 trillion starts moving from hands that hold gold to hands that hold Bitcoin. That's not a price prediction, that's demographics. And demographics are the one thing in finance that moves slowly, predictably, and then all at once. It hasn't fully priced in yet, but here's where most people make the mistake that costs them. They hear all of this and immediately ask the wrong question. Should I buy Bitcoin or gold? Wrong question. That framing assumes they're competing for the same job. They're not. Gold is a contract. 5,000 years of human consensus that says, when everything else fails, this holds. No electricity required, no internet, no functioning court system, no counterparty, just physical reality and collective agreement that has survived every empire that ever tried to replace it. Bitcoin is a bet. Specifically, a bet that the next 50 years look more like the last 15 than the last 500. That digital is permanent. That decentralization wins. That a 21 million coin hard cap enforced by code is more trustworthy than a central bank's promise. Both bets are rational. They're just betting on different futures. If you believe civilization stays broadly stable and the financial system continues functioning, gold does its job quietly and you sleep fine. It won't make you rich, it'll keep you from getting poor at the worst possible moment. If you believe the financial system is being structurally rebuilt, that in 20 years digital assets are as normal as index funds, that the dollar's reserve currency status is genuinely threatened, that the kids inheriting $84 trillion will reshape markets in their own image. Bitcoin is the asymmetric play that gold structurally cannot be. Here's the honest answer most finance channels won't give you. The serious long-term money doesn't pick sides. It holds both, deliberately, not randomly. Gold is the floor, Bitcoin as the upside. The ratio isn't fixed. It shifts with your age, your income stability, your actual risk tolerance. Not the risk tolerance you imagine you have until the 60% drawdown hits your account at 2 a.m. A 28-year-old with stable income and a 20-year horizon can reasonably hold more Bitcoin than gold. A 58-year-old protecting retirement savings should probably think about it the other way around. Neither is wrong, they're just honest about different futures. Here's the simplest version of everything we just covered. Gold protects you. Bitcoin could transform you. Cash, just sitting there, is the option, with the worst long-term track record of all three because inflation doesn't announce itself. It just quietly makes every dollar you're not growing worth a little less every single year. The investors who look back in 20 years and wish they'd thought harder about this aren't the ones who picked the wrong asset. They're the ones who kept meaning to think about it, and never seriously did. The question of Bitcoin versus gold isn't really about charts or market cycles or halving schedules. It's about which version of the future you're willing to bet on. And right now, in 2025, that bet is still open. Most of the people who will win it aren't the ones with the best predictions. They're the ones who positioned early, held through the noise, and understood why they were holding, not just that everyone else was. If you want to go deeper on the actual allocation math, what percentages make sense at different risk levels, how to rebalance as Bitcoin matures, that's worth a separate deep dive, and it's the next logical step from here.